Hi everyone and welcome. It's Steve Johnson here, Chief Investment Officer at Forager Funds, recording this video from locked down Sydney. Once again, Alex, we're at a distance and back on Zoom, but plenty of interesting stuff to talk about today, particularly in the IPO market. It's been pretty red hot out there recently.
It has indeed. Now, the year to June 21 is the largest one for IPOs in about a decade in Australia. Now, of course, a lot of those are in the mining space, as they often are in Australia. Explorers and companies that are raising money from the public to then plow it into the next great nickel or iron ore deposit that they hope to find. There are also quite a number of other categories, and one of the more interesting ones is the non-bank lenders. So a lot of these businesses had been private. They are names like Latitude and Pepper Money, companies people will be quite familiar with. They have also come to market alongside some of the smaller non-bank lenders that we might get onto a little bit later.
Yeah, and it's a space that is one where there's information asymmetry, I'd call it. You've got some pretty sophisticated sellers making these businesses look good so they can maximize their IPO price. We've already seen quite a few blow-ups amongst these recent IPOs.
That's right. And usually the sellers into IPOs that are most readily accused of dressing businesses up and timing particularly well are the private equity funds. And we've already had, as you say, quite a few blow-ups in that space. Now, they do get a bit of asymmetry of information. They know things that the investors buying in that IPO do not, and they've got the benefit of timing that. So one that's been particularly interesting of late is Nuix. So the business listed to great fanfare. It doubled off its IPO price in the first couple of weeks and has subsequently gone through quite a lot of very heavily reported issues. And the stock is now down 75% from its peaks and half of its IPO price. There was another that almost made it to listing, and that's Graze Online. Now, it was bought by a private equity firm 18 months ago, and here it was trying to list that business for 8 times the price that they paid. Now, that one didn't quite get away. It was very much the same business that they bought 18 months ago, but there are similar stories around the market, and it has been that way for quite some time.
Now, we don't participate in that many IPOs at the time they happen. One of our recent massive successes, Mainstream Group, was an IPO, but it's not particularly common for us. We do love sifting through the rubble when these things start going wrong. Are you finding opportunities out there at the moment? And maybe even starting with Nuix, lots of commentary there that the underlying product itself is quite good.
Yeah, so the Nuix business definitely has a lot of hairs on it. So it's one we've steered clear of for now, but have done a little bit of work on. We tend to stick to the ones where the underlying business is actually quite solid, but through some sort of short-term issue, the business had been sold down, or even that the IPO price itself was inflated by 20, 30, 40% above a reasonable number. We can lie in wait there, and we have done so for a couple of businesses that we've bought in the portfolio in the last couple of months that were quite recent IPOs. So Adore Beauty is one of those. We got the opportunity to purchase that online seller of skincare products for about a quarter below its IPO price. Now, the business has had some hiccups, but the long-term trajectory in their revenue growth seems to be quite solid. Another is a non-bank lender that we cited before, a smaller one this time, Plenty. So the business IPO'd in late 2020. It was also trading quite substantially below its IPO price, and we've also been able to acquire that one for a quarter under its IPO price. And here they're taking customers off the banks. Those trends continue, but another one which was probably a little bit too aggressively priced at the IPO stage.
Yeah, that's exactly right. And I think finding these businesses where some of the sales pitch they give you at the start is actually true, that there's long-term tailwinds and a good structural story, but where they've just been too aggressive on pricing. Adore a really good example, I think, of it's going to have to unwind some very high growth rates because of COVID, but the structural story there is a very good one. We had JB Hi-Fi out this morning with a another profit upgrade and a share price trading at almost $49. Worth remembering that it too was once an IPO at $2.20 per share. So they can be very, very successful when you find the right business and get to pick them up at an attractive price. Thanks for tuning in.